Let me ask you something. If I offered you 100 money units today or 100 money units a year from now, which would you choose? Almost everyone says today. And that simple instinct explains one of the most important ideas in finance, the discount rate. The discount rate is the rate used to translate future money into today's value. It answers a simple question: how much is money in the future worth right now? If the discount rate is high, the future money is worth much less today. If the discount rate is low, future money keeps more of its value. There are three main reasons why future money is worth less than money today. First, risk. Future is uncertain. Second, there is inflation. Prices usually rise over time. And third, there is opportunity cost. Money today can be invested or used right now. The discount rate bundles all of this into one single number. Imagine someone promises to pay you 1,000 money units in 5 years. That sounds nice. But what is worth today if inflation is high or the risk is also high? That future payment feels less attractive. The discount rate is what turns that future promise into a realistic value today. Investors use discount rates to value companies, projects, and assets. When analysts value a business, they estimate future cash flows and then discount them back to today. A higher discount rate means a lower valuation. A lower discount rate means a higher valuation. This is why interest rates matter so much for markets. Central banks also work with discount rates, but in a different way. When interest rates rise, the discount rate across the economy rises too. Future income, future profits, and future growth are all valued less today. When rates fall, the opposite happens. That is one reason why rate decisions affect everything from stock prices to house prices. When the discount rate is high, people and companies prefer the money now. Long-term projects become harder to justify. Investment slows. When the discount rate is low, the future feels more valuable and long-term investments look more attractive. This is why the discount rate influences growth. The discount rate is not always the same as the interest rate you see at the bank, but interest rates strongly influence it. In practice, the discount rate reflects a combination of market interest rates, risks, and expectations about the future. Think of the interest rate as an anchor and the discount rate as the full adjustment. Level of the discount rate matters even if you never invest. It affects mortgage rates, pensions, salaries, and government spending decisions. A higher discount rate makes the future feel smaller. A lower one makes it feel more important. Whether we realize it or not, the discount rate shapes long-term decisions everywhere. Think of the discount rate as the bridge between today and tomorrow. It is not just a technical term. It explains why money now feels more powerful than money later, and why changes in interest rates ripple through the entire economy. If this helped you understand how finance values the future, subscribe to the channel and tap the bell button so you never miss the future videos. I explain complex money ideas in the way they make sense. And tell me in the comments, where do you feel high interest rates the most?